Hello and welcome to Quilter Cheviot's Market Uncut podcast, your weekly insight into the topics and trends that we have been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, to be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Fraser Wilkinson, investment manager based out of our Leeds office. And this week I'm pleased to be joined by Oli Creasey, one of our equity analysts. Good morning to you. Oli, there's been a lot of movement recently in the investment markets. Seem to be started by interest rates moving around in the UK and EU, but not in the USA. Then unemployment moving around in the USA, upsetting markets. Then Japan and the currency markets moving around. But the focus of today's podcast is to talk about the steel price and iron ore. I was just wondering if you could tell us what's going on with the iron price at the moment.
Yeah, hi Fraser. Thanks for the intro. It's a bit of a deep dive, I suppose we could do here, because the iron ore price has fallen pretty sharply, and it's in the news at the moment because it's on that trajectory, but also it's breached the $100 per ton mark, and a little bit similar to the $100 a barrel oil price, I suppose. That $100 is a slightly symbolic number, but it does have it's kind of got a meaning to it beyond the actual number itself, right? You're suddenly into the double-digit terrain, and it's everything looks a little bit worse than it did before. But the real message is that the iron ore price has fallen pretty sharply. It was about $120 back in May this year, and actually started the year pretty close to about 140. So you can do the maths and see it's fallen pretty sharply over that period. And as you as you mentioned, iron ore and steel prices are not sort of moving completely in lockstep, but they're very closely related. Iron being sort of the key ingredient, I suppose, in steel making, and interestingly enough, the other being coking coal. So a specific grade of coal is one of the other key inputs in the steelmaking process. So that has also been on a bit of a journey. All three of those commodities down pretty sharply and causing implications all over the place.
Yeah, I think markets can be a little bit jittery at the moment. We've got thin trading in the summer, and I think people are looking for all sorts of problems and things to be worried about, just in the assumption that because we've had a reasonably good year on the equity markets, that they need to look for excuses to take profits. So in this particular sector, what are the underlying causes of the weakness in the iron price?
Yeah, this is and this is one that does seem to be driven by fundamentals, by the way. So yeah, you're right about the summer trading and so on, but I think there are deep-rooted causes here, and as is often the case, I think it's a bit of a look eastwards to figure it out. I'm referring to the Chinese market. I'm sure the listener is well aware that China is both the biggest producer of steel, the biggest consumer of steel, and actually also the biggest exporter of steel. So it's a bit of a triple threat in terms of the steel market. But the problem that we're facing, and that we're all facing, I suppose, is the rapid slowdown in the Chinese property market. I'm sure you've seen the headlines. It's in a bit of a mess. It's really in the doldrums at the moment. And new construction in China has fallen pretty sharply. Clearly, that's a key use for steel, not the only use, but one of the key drivers for its demand. And that slump has had a sort of a ripple effect, and we're seeing that throughout the various markets. Iron ore inventories are building. The sort of the docksides, metaphorically lined with containers full of iron ore, just at a moment in time where you would normally expect it to be falling. So it's quite a seasonally cyclical industry. The summer months are when most steel is produced because it's when you get the warm weather. So to see that inventory building now is just the worst timing you could imagine. And the steel market is similar. We're seeing inventories rise, we're seeing exports rise, just even though the actual manufacturing volumes are down. So even though the Chinese producers of steel are making less than they normally do, they're still struggling to find a viable market to sell it on. So it is quite a bleak one. And while I've leveled the target very much at the Chinese property market, and that is a big part of it, it's probably not the only one. And steel is consumed and shipped globally. Lingering recession fears in some of the other markets are probably also to blame. But it's a pretty bleak situation. Let's be clear about that.
So in terms of client portfolios, the UK stock market is quite dominated by miners and natural resources companies. So sometimes movements in different commodities can have an outsized effect on the UK stock market. So I guess as an analyst, telling us which shares are the right ones to buy and the price to buy them at, what does the movement in the iron price mean for the companies that you're looking at in the mining sector?
Well, as you can imagine, it's not been a great time to own a mining stock, particularly one that's focused on the basic metals like iron. And actually, it's also notable that iron isn't the only metal that's been having a tough time of late. So you think about companies like Rio Tinto and BHP, both very exposed to the iron market and those adjacent to it. Those shares have had a tough time recently. Now, the temptation is, I suppose, when something like this happens, would be to avoid the iron ore market in its entirety. But as you mentioned, it's a significant part of the various benchmarks out there, particularly when you're looking inwards at the UK. And to take a big bet on the iron ore price continuing to fall from this level, could leave you quite exposed if things actually swing back the other way. Now, I'm not sure I really want to go on record and say I believe things will swing back the other way, but more to protect the client portfolio against that sort of surprise outcome. We might be underweight the sector, but we wouldn't be heavily underweight just because it's such a big swing is available there. Both of those companies are also pretty cheap as it happens. So you look at Rio Tinto, for example, and you'd be buying in at a price to earnings ratio well below 10 times for the next couple of years. So thinking about historic averages, that's pretty undemanding as a valuation point. So yes, there's weakness there, and it's a painful market to be operating in. But I would also highlight that those big companies, they manufacture, well, no, they don't manufacture, they mine iron at an approximate price of sort of $30 to $40 per ton. So they're still going to be making profits. They're still going to be reasonably comfortable with a price in the sort of 90s that they're ultimately selling at. So we're not super alarmed at this point about the prospects for companies like that. Now, the other company that we should talk about in the sector is Anglo American. As I'm sure you're familiar, they were subject to M&A, and not speculation, but actual events earlier this year when BHP made an informal offer for the shares, which was ultimately withdrawn and rejected and has gone away. But management have responded by undertaking a strategic review and are now pursuing effectively a breakup of the company. So they are selling 4 different divisions, selling nickel, coal, platinum, and diamonds out of the business to leave a smaller and simplified iron ore and copper business behind. It's not going to be an easy journey, and those sales are expected to take place over the next 18 months or so. But if they are successful in doing so, it should add significant value to shareholders, however that cash ultimately ends up getting returned to them, whether it's a dividend or something else. And of course, if it's not a successful outcome, then we do know that those M&A sharks are circling the business and could well come back into play. So it's one that we see there being additional value above and beyond the shares. And if you sort of take a look at the reasons for that, you may come to a similar conclusion.
And I guess for our long-term investors, there is a bigger picture to look at, which is that investments and prices come and go. But the actual mining companies that we're invested in, how are you feeling about the management beyond things that they can't control, like the global steel price?
Quite. I think it's fair to say that the management it's a key factor in the analysis that we do. Do we trust the management? Have they got that track record and the ability to manage some very big and reasonably complicated companies? And the short answer is yes. I think the response from the Anglo American team, it was mature. I think there's always an accusation that can be leveled at big companies that they're empire building and that the management just want to preside over a bigger business. So it always seems like quite a mature response when a company says we're willing to actually shrink who we are and make provide the best returns possible to shareholders, even if that means presiding over a smaller business. So they get credit for that approach. And I think we'd say similar things about Rio Tinto, for example. They run a tight ship, and while there's always talk in this sector about M&A, we see good discipline from those management teams. You always worry that someone's going to go out there and make a frivolous bid for something that takes their fancy. In reality, rarely does that end well for the acquirer, and it's probably better for the acquiree. So seeing management say, we're open to it, but only under the completely correct circumstances is encouraging to hear.
Wonderful. Well, thank you, Oli, for those great insights, and to all of you for listening. Did you enjoy our discussion on the podcast today? We'd love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quiltercheviot. To make sure you don't miss a future episode, tap the subscribe button. We will be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And finally, do you have any questions that you'd like to ask one of our experts for our next podcast? Simply ask them via the weekly comments page on our website. We would love to hear your questions. And that's it for today. So thank you, Oli, and all of you for listening. See you next time.